Disney is trading down near their 2020 pandemic lows at around $79. But we're seeing Wall Street be extremely bullish on the stock. We have 19 different investment firms with buy ratings or bullish ratings on Disney, and we have one investment firm with a bearish rating. So we're talking about a 19 to 1 bull to bear ratio on Wall Street. So this tells you that Wall Street is unanimously, or not exactly unanimously, but there's a general consensus that this stock is a buy, right? So given that, you can expect that the large investment firms will be buying the stock on the dips. And I think this dip down to the COVID lows is really a Bible dip for Disney. And I'll give a price prediction at the end of the video. But what I'll do in this video is I'll run through some of these analyst ratings, and then I'll cover some of the fundamentals of the stock, and then I'll go through the financials as well before I give my price prediction. So in terms of the recent price changes, so we saw Rosenblatt reiterate their buy rating at $102. And then we saw Wells Fargo maintain their overweight rating with a $110 price target, but they obviously dropped their price target down to 110 from 146. So that's kind of the most recent updates, but we can still see that obviously 19 to 1 in terms of bulls to bears definitely shows that Wall Street is seeing the stock as a massive buy. So with that being said, let's take a look at some of the fundamentals of Disney. So the Wall Street Disney Company is facing challenges in its traditional cable and broadcasting divisions with declining viewership and profits. This is from a article written by Daniel Jones from Seeking Alpha. Management is actively seeking strategic alternatives for these assets, including a potential partnership or sale to companies like Apple, Amazon, or Verizon. The company's streaming platforms such as Disney+, ESPN+, and Hulu have seen growth and are becoming increasingly important for Disney's future success. At first glance, it may seem as though the more traditional cable and broadcasting parts of the company are doing reasonably well, but when you dig deeper and focus especially on the most recent results, it's become clear that the company does have some issues. There have been rumors circulating that the market, there's been rumors circulating that the market that management is seeking to switch things up, and management has even gone as far to say they are exploring strategic alternatives for certain assets. Upon looking deeper into this picture, I would say that this kind of maneuver is definitely warranted. With changes in consumer behavior and technological innovation, we have seen at least one key part of the business become antiquated, and investors should view the rhetoric engaged in by management, as well as any actions that will likely stem from their initiatives, as bullish in the long run. This is because it shows a management team that is acutely aware of the weakest parts of the company and is willing to act on this realization before matters get out of hand. So let's talk a little bit about Disney's pain points. So much of the discussion has been made online, has involved what Disney might do with ESPN, but we need to put the picture in a broader context because their efforts at improving operations don't include only ESPN. Rather, they encompass the entire linear network division, which is one of the three operating units under the Disney Media, Entertainment, and Distribution segment. For context, the division includes not only Disney's 80% ownership of ESPN, but also its full and partial ownership over various other enterprises like ABC Television, Disney, National Geographic, Fox, A&E, and History, Lifetime, FX, and more. We can see that breakdown right here. The linear network revenue has been going up over the past couple years, very slightly though. And then, outside of the affiliate fees, the next largest category for the company has been advertising. Revenue has actually grown from $8.2 billion to $9.1 billion. Strength in cable advertising, driven by both higher rates and higher impressions, more than offset weakness under the broadcasting category that was attributable mostly to the drop in impressions for some parts of the company. ABC, for instance, reported a 12% drop in impressions, reflecting the lowest average viewership from 2021 to 2022. The revenue picture would have been worse had it not been for a 10% increase in rates charged to users. So they're kind of seeing a drop in usership, but they're jumping or they're increasing those fees, those subscription costs, which is kind of balancing things out. And then we could take a look for the first 9 months of this year, the firm had to dole out an extra $310 million under its cable division alone, largely because of the contractual rate increases that it has to pay for the NBA as well as college football playoffs in the NFL. So they're paying up for content on cable, right? And we can see that their subscriptions over the past couple of years has dropped pretty significantly in some categories. So when we take a look at the Disney Channel was at 85 million subs in 2020, and now in 2020, or excuse me, last year in 2022, this is kind of a full year analysis, we saw that drop to 74. So Disney, the other channels here, Disney Junior, Disney XD also dropping. ESPN has dropped from 84 million to 74 million in 2 years. Same thing for ESPN2, ESPNU, all dropping. ESPN News dropping as well. SEC Network dropping. ACC Network had a slight increase. FX dropping. National Geographic dropping. So a lot of these channels are seeing their subs drop off, which is not good to see. And then it is good to see, though, that we see in sports, the sports sub have been kind of sticky. A&E has dropped. The History Channel has dropped. So Lifetime has dropped, right? So all their subscriptions are really dropping off a cliff, which we don't love to see for a company. And that's why the company's kind of exploring some strategical partnerships, you want to call it, possible buyouts even of some parts of their business. I think that's smart. I think they should really try to focus on a couple really good channels, or Disney networks, whatever you want to call them, and rather and sell off some of the underperforming assets, such as ESPN. With that being said, let's take a look at some of the financials for the company. So the PE right now is at 25 times. And that is actually below Disney's 5-year average. So the 5-year average is at 28 times. So Disney is definitely trading at a discount relative to its own history. And then we take a look at the price to book ratio quick. So we have a price to book ratio of 1.5. That is below the sector median and is below the company's 5-year average. So when we take a look at these valuation metrics, the company is definitely trading at a discount in terms of valuation basis, when we look at the PE and the price to book ratio than it has in its history. So we can also take a look at the growth. The growth hasn't been that bad, I do have to say. So revenue growth year over year is at 8%, which is basically in line with Disney's 5-year average of 9.6%. And then we can see revenue growth for the next 12 months is at 11%, which is just slightly above Disney's 5-year average. So with all that being said, I'll keep it moving here on to their profitability metrics. So the company has a gross profit margin of 32%, which is below Disney's 5-year average of 35%. And we have a net income margin of 2.5%, which is below the sector median and below Disney's 5-year average of 6%. So on a profitability basis, the company is definitely trading it's reporting numbers that are worse than the company's own history. So that obviously isn't a good thing. And then we have cash per share at about $6. So that is definitely a good chunk in cash per share. Definitely, gives the company a decent floor. And then with all that being said, let's take a look at the company's chart and give a price prediction based on technical analysis. So we're coming down to test support at about $79, which is where shares had bottomed in 2020, as I had said. So I see it as likely that we find some support around this level and we see a move higher for Disney over the coming weeks. That is kind of what the technicals are telling us here. We're also nearly oversold according to RSI. So that should help, kind of push shares higher and, use this level as support. I do think this oversold condition coinciding with testing major support should bode well for the stock over the coming weeks. So with that being said, let's take a look at some of the seasonality trends for the stock. So the worst month in the stock's history is September, unfortunately. So on average, shares decline 2% in September. Obviously, don't love to see that, but it is, just the fact of the matter. So September is the worst month in the stock's history, but it's good to see that we're actually moving into a bullish seasonal trend. So October, November, and December shares do typically rise. In October, they rise 1.3%. In November, 1.9%. In December, 1.8%. So yes, this is a bad month seasonality wise, but we're moving into a good upcoming 3 months here as we kind of move into the winter and the fall for Disney. So 54 years of pricing data to kind of back these numbers up. So I definitely do think this holds some weight. So with all that being said, I do think the chart is screaming that Disney could likely rebound from here. Obviously, they have some issues within the business, and I would like to see some of them solved before I kind of said this is a long-term hold here. But like I said, major support level at $79. If you liked Disney when it was, $200, I don't really see a reason why you wouldn't like it here. So it could be a very good dip buying opportunity for those that are looking to, dollar cost average their Disney holdings. This does seem like a really good spot to dollar cost average into some shares here as we come down to test a major support level. So with all that being said, I hope you enjoyed the video. I will end it there. If you got some value from this video, please leave a like. We post company breakdowns and important market moving news on this channel on a daily basis, so make sure you are subscribed. If you would like to receive my daily portfolio moves, my exits, my entries, and see how me and my team of analysts are trading the markets, join the Discord through the link in the description below to get our free 7-day trial. Also, if you would like to join our free daily newsletter, sign up to our Substack, which is linked below as well. With that being said, good luck everyone. Happy trading, happy investing.